Good afternoon, good morning, depending on whichever part of the world you are in. Thank you very much for coming to the last ASB CSAN Center seminar on macro finance and emerging markets, the last one of the year. And we are very happy to have Debbie Lucas from the MIT-Sloan today. But before coming to Debbie and the topic, a few advertisements both from the ASB, the Asia School of Business, and also from the SEACEN Center. As you might have attended some of our seminar series, joint seminar series, which started this year, we had a great year, and we are very happy to have the kind of speakers we have been able to attract and kind of topics that we have been able to discuss in front of you. Early next year, in January and February, we'll be having Matteo Maggiore and Elizabeth Kemp from Stanford and Chicago booths, respectively, on two equally interesting topics, and hope that you would be joining us in those seminars. As you probably all know, the Asia School of Business, in collaboration with MIT-Sloan, is offering a new Masters of Central Banking program, in which Debbie, of course, is meant to be teaching. I believe will be teaching when the program starts. So if you are considering a world-class program specifically on central banking, please take a look at the link that is here. The Asia School of Business has a few central banking related initiatives that are forthcoming. The first one is joint with the SEACEN Center on the recent report by the Independent Evaluation Office's report on the IMF's advice on capital flows. Hans Genberg from the Asia School of Business will be chairing that, and I hope you can join us. And a couple of additional ones with former policymakers, including Dr. Zetti, who is the chairman of the ASB, as well as Paul Tucker, of former Bank of England, and two other central bankers, former central bank governors from Northern Europe. About the SEACEN, we will be closing the year with the top two seminars. One is going to be on few time series econometrics on 8th of December. Second one is going to be on artificial intelligence and central banks. What's in it for central banking? And next year we'll kick off with Marlene Hu from Vanderbilt on macro effects of household leverage regulations after the crisis. As I said, we are very pleased to have Debbie Lucas to join us today. Debbie is the Sloan Distinguished Professor of Finance, MIT-Sloan School of Management, and also the Director of Global Center of Finance. Debbie's research focuses on developing and applying financial economics to evaluate costs and risks of government's financial activities. Her research has been published in American Economic Review, Journal of Political Economy, Journal of Monetary Economics, among other top journals. She's a research associate at the NBER, a term professor at the PBC School of Finance, and also a member of the Shadow Open Market Committee in the US. She serves on the advisory boards to Federal Reserve Bank of New York, the Urban Institute, and you can read the rest yourself. But one other thing I would like to highlight, like most of us, Debbie was also a practitioner herself. She was the chief economist and subsequently assistant and associate director at the US Congressional Budget Office. And she holds BA, MA, and PhD from Chicago, from nowhere else. That's all I would like to say about Debbie. Debbie, thank you very much for joining us today. And I now would like to turn the floor or the microphone to you.
Thank you very much, Ozer. It's a pleasure to be here. I really appreciate the invitation and the opportunity to talk to central bankers from so far away. I'm going to just take a second to share my screen. So no, I was saying it's a pleasure to be with you all. Unfortunately, remotely. I have to admit I don't miss the day-long trip to Asia, but I do miss the people and the food. So I wish we could do all that through Zoom. So I'm going to talk about the case for monetizing pandemic relief. This is actually an idea that grew out of many discussions and finally a Vox EU blog post with Rafet Gurkaynak, who many of you know. I hear he's given a number of talks to this group. So it'll be interesting to hear your reactions. So we're motivated by thinking about advanced economies and other economies as well, facing three interrelated macroeconomic challenges. One is, of course, to meet the unprecedented spending needs to respond to the COVID-19 crisis and the economic disruption that it's caused. Secondly, there's the need to hold government debt, which has been growing rapidly to a sustainable level. And third, avoiding deflation and trying to reach central bank inflation targets. So we believe that monetizing some pandemic-related debt would actually be the best way to address all three of these challenges simultaneously. And sort of the heart of what we're doing in our proposal is to try to operationalize how this could actually be done. That is, how to permanently replace government debt with non-interest-bearing claims, essentially money. It turns out that, of course, it's easy to say we should monetize the debt, but functionally and legally, it can be quite complicated. And all of this led us to go back to the basic ideas and mechanics of monetization and to think about questions like, well, how does it differ really from quantitative easing? So I want to share some of those ideas with you also today. So on the flip side of things, it's a pretty radical proposal to suggest that central banks should be monetizing their debt. And so I want to discuss a little bit the risks. And also, I think a question that will certainly come up is, why are we focusing on large developed economies? Why not smaller and less developed countries following a similar policy? And I'll offer some thoughts on that. So that's kind of the roadmap. I want to mention that if people have questions and have a way of submitting them, I'm happy to answer any questions at any point, so please feel free to interrupt me. Okay, so I thought I would start by just elaborating a bit on the challenges with some numbers that will probably be familiar to many of you. But as you know, it's been incredibly expensive to try to buffer the income shocks to individuals and businesses and the health shocks that have arisen with COVID. The assistance that's being provided, I just want to note, I think is better thought of as social insurance than as any kind of traditional fiscal stimulus. I think that the goal is generally to make sure that people and businesses can sustain themselves. It's not the usual kind of stimulus that's in response to a lack of aggregate demand. And I think having that mindset is an important way of thinking about it. But in any case, the fact is there's been an enormous amount of additional spending, at least by the countries that can afford to do that. And this first picture is just showing you the case for the United States, where the budget deficit this year is going to reach a record $4.2 trillion, which is really quite phenomenal. You know, we thought of the global financial crisis and its aftermath as an enormous shock, but this COVID shock in terms of government spending dwarfs anything that happened a decade ago. Turning to Europe, kind of the same story. The recession hit different countries in the Euro region to different extents, but for all the countries, there's been a very large drop in their real GDP. And there too, the need to provide assistance to their citizens created spending that's pretty much off the charts for Europe. You know, Europe basically tries to have something close to a balanced budget requirement, but they remove those restrictions to allow the countries to respond more aggressively to COVID. So the red bars are just showing the budget deficit as a percent of GDP for the various Eurozone countries, and also quite large, totaling about 97 billion euros. Okay. The other graph I included here is one I came across recently that I thought was particularly telling. And what it's doing is it's not just reporting government expenditures, but it's also adding to that government loan guarantees, government loans, and other kinds of credit assistance. And so what you can see from this is that countries where it looks like actually they weren't providing that much fiscal support in the traditional way of expenditures did greatly expand their credit-like support. So you can see that in Italy, in the UK, in Germany, and so that just gives you a sense of the kind of massive expansions. I'm mentioning that partly because government credit policy is actually the thing I work on the most. In the context of the pandemic, it lies somewhere between monetary and fiscal policy, but it's quite important, and particularly in Europe, it's not very well measured. It kind of slips under the budgetary radar there. So it's cheap in some sense to use credit policy, and it may actually get less scrutiny than monetary policy. So it's just something to keep in mind when you're thinking about the scale of the kind of government assistance that's going out in the face of this crisis. Just to kind of comment briefly on it, I think there is a fiscal equivalent to credit policy, which you can define as the subsidy element of that credit policy. So in the case of the United States, some of the credit assistance that it put forth was actually forgivable loans, and those forgivable loans were essentially equivalent to their full expenditure value, whereas a loan that's very likely to be repaid has a very small fiscal element. Okay, I don't want to go off on too much of a tangent on that, but since I have your attention and it's an opportunity to mention that, I just think it's very important in terms of measuring the size of government interventions. Okay, so we have this massive needed spending, and clearly the question, a lot of people are talking about the issue, well, are all these deficits leading to unsustainable levels of government debt? For a picture that's representative for the United States, I went to my go-to source, which is the Congressional Budget Office. This is the long-term budget outlook cover. I was actually involved, my first project when I got there was to help write the very first edition of the long-term budget outlook. And it certainly didn't look that bad when I was back there in 2000 working on it. But here, this is the federal debt relative to GDP. It grew enormously following the financial crisis, but then the growth in response to the pandemic was another big jump up. I mean, a reason I love this graph is that traditionally, what most governments do is they accumulate a lot of debt, say following a large war, but then they draw it down, or there's a Great Depression or a Great Recession, and you draw down the debt after you build it up. But what we didn't do after the financial crisis and the Great Recession is we kept on building up our debt so that when we entered the pandemic, we already had very high level of debt to GDP, and it's projected well above 200%. There's some interesting recent academic papers which are thinking about the sustainability of the US debt in a more rigorous way. And you may have seen this paper that I referenced at the bottom of the slide, where they talk about the US public debt valuation puzzle. And basically they're saying that there's no way that projected future fiscal surpluses could repay the debt using any reasonable level of discount rate. So they're pretty much saying we're probably in a bit of a bubble on US debt. I don't want to overly focus on the US, and I actually wanted to provide more data on Asia and the Pacific. The thing about the United States is there actually are more projections going out further, at least that are ones where I know where to find it. But thinking about the starting debt levels in other countries that have been really hard hit by the COVID crisis, you can see from the table that for large economies with high infection rates, they already have a very high debt to GDP ratio by any kind of a normal historical standard, with the exception of Germany, which doesn't look so bad. If you go to Asia and the Pacific region, actually the debt to GDP looks much more normal just about everywhere, except of course Japan, which has been an outlier for a long time with a 266% debt to GDP ratio. Okay, just another point of reference. But in any case, for these countries, these large economies that are spending a lot on COVID, they already have extraordinarily high debt to GDP ratios, and those are expected to get much larger in the future. So as I mentioned before, there's a question for the United States, for Japan, for Italy, for other heavily indebted countries of whether the debt really is sustainable, whether it can be paid back. So I think a topic that I'm interested in your views on, and I've been thinking about for quite a long time, is for emerging markets, there's quite a large literature on sudden stops. The idea that all of a sudden foreign investors might stop being willing to buy the debt of certain countries, and that will have quite negative consequences. But with these high emerging debt levels for developed countries, for Europe and the US, there's a question of, well, what could or would cause a sudden stop in these countries? And so this gets back to, I know, a topic you all have been discussing a lot, which is MMT, modern monetary theory, or the idea that with extremely low interest rates and low inflation, the debt carrying capacity of many countries have increased a lot. And so that really this accumulating debt is sustainable. Personally, I've not understood why people could possibly say that with a straight face. I guess that's a little strong, inviting controversy, but I mean, there's no guarantee that interest rates will stay low or that inflation will stay low, and even more importantly, a lot of what will happen depends on investor sentiment. What could cause confidence to waver? When will they stop buying debt? They could stop buying debt much before there was any significant jump in interest rates. So I think really an important challenge for academics and for central bankers in terms of modeling is to think more about going beyond a traditional macro approach to sustainability in a way that incorporates investor sentiment, risk premia, and perhaps trying to address this issue of sudden stops for more developed countries. Okay, so my third challenge was that central banks are concerned with heading off deflationary pressures. We know that in the US and the EU, policy rates are near zero. Interestingly, like for the debt, Asia and the Pacific are in much better shape than the US and the EU in that interest rates are still a bit higher. Policy rates have come down, but my understanding, at least from what I've seen, is that the problem of the zero lower bound and deflation is less of an issue. Okay, so that was kind of to say we have a lot of challenges, and our proposal is that these advanced economies with high debt levels and big bills should be monetizing some of the pandemic related spending. So the basic idea is really simple. What we'd like to see is the equivalent of a limited and targeted helicopter drop of money. And other economists have made very related proposals. Jordi Gali has written nicely on the subject. So in our particular proposal, what's a little bit different is we're really emphasizing tying the monetization to pandemic relief. Okay, and I'm going to talk more about it in a second. But basically, you can print money and give it to people who are suffering because of the pandemic, who have lost their jobs or whose businesses are on hold. Okay, so why are we trying to tie monetization specifically to pandemic relief? Well, I think the main reason is really one of political economy. You really want to discourage politicians from thinking they can turn to monetization when they don't want to raise taxes, when they want to spend money. And also, if the central bank is seen as being quite willing to just monetize when debt levels get high, ultimately it has to detract from their credibility and eventually lead probably to a threat to their independence. And in any case, the purpose of the independence of central banks is to avoid inflation, essentially to avoid monetization. So we want to be very careful about how we go about proposing monetizing. Okay, so as I mentioned when I first started, I think how to accomplish it as a practical matter is a lot more complicated than just pulling out your helicopter. The details are very sensitive to the legal framework of a particular jurisdiction, and I think it would be quite complicated. As Rafat and I tried to work it out, it took us a surprisingly long time to keep on refining and going back to what would work, even in the US example I'm going to show you. And I think we both understood the US monetary framework and fiscal framework pretty well. So I hesitated a little bit to get into the details of our proposal for the US, but I think what we think has to happen in this case is in some ways quite general, and I'll try to circle back to that. Okay. So there's two main pieces, which are the two major bullet points on the slide. The first is that basically this program would be initiated by the legislature, by the Congress, and they would direct the US Treasury to create special issue bonds that were essentially like money. So that's part one. And then part two is that the value of those bonds would be credited to targeted individuals, say checking accounts at banks, in amounts that are determined by the program rules. Okay, so just to stick with that second point for a second, you could imagine that you wanted to send more pandemic relief to people whose unemployment benefits had run out, or to small business owners who aren't operating their businesses. And so the money would basically go to the banks, and the banks would credit those bonds on the asset side to the liability deposits of the people who they were trying to help out. Okay. So let me say a little bit more about these special issue money-like bonds. One thing that would work would be to create zero coupon perpetuities where the face value is the amount of money that you're using for that pandemic relief program. Why zero coupon? Well, we're trying to create something like money where the government has no future liability to make any payments. And by making it a perpetuity, we also never have to pay back the principal. So we've basically created an obligation that's no obligation whatsoever, but it does have a face value. Okay. So this program that would be legislated by Congress would actually require the Fed to buy the bonds from the banks at par. And in the usual way of Feds buying securities from commercial banks, they would pay for those securities with reserves. In this instance, we have to put in the twist that they're paying with non-interest-bearing reserves. The problem is that if they were paying with interest-bearing reserves, we'd be back in a situation where there was some ultimate claim on the government for repayment. Okay. So these zero coupon perpetuities would remain on the Fed's balance sheet indefinitely. There would be no future cash flows associated with them, and this would have effectively monetized those bonds that were issued. So all of that seems highly complicated when, as I keep on saying, what we really want to do is have a kind of a targeted helicopter drop and just throw money into the checking accounts of the people we want to help. So why all of this complication? Well, what's very important is that this is a fiscal program. The government is directing that monies are allocated in a specific way. There's no way the public or anyone else should rightly view this as really monetary. It's a fiscal program. And in the US, fiscal policy always requires legislative authorization. So it has to start with Congress. Part of the legislation would direct the Fed to be undertaking what's going to be effectively monetization. And that prevents the Fed from initiating a fiscal action. So there's really two reasons for this. Again, it's because the Fed really isn't legally allowed to initiate fiscal actions. But furthermore, in the court of public opinion, they probably shouldn't initiate fiscal actions. And this is something where I think the attitude toward this may be quite different in different countries. There may be central banks where there's not such a stigma about undertaking things that are clearly fiscal. My own sense of what the EU is doing these days is it's much more fiscal without apology than when the Fed is doing anything. Another thing I might note is that this kind of a policy procedure is very similar to something that is really happening, which is when Congress in the United States passed the CARES Act to provide funding for pandemic relief, and it created the programs that the Fed is now running, which provide credit facilities to various targeted borrowers. Basically, this is what happened. The legislation said the Fed has to run these programs, and also the legislation created fiscal authority to pay for any credit losses from the programs so that the Fed wouldn't be taking the fiscal hit. They would just be administering the program. Okay. Okay, so basically all of that preserves the divide between monetary and fiscal policy, and hopefully will help to avoid future challenges to the Fed's independence. So I think the reason it has some universal relevance is that there are questions all over the world about what the limit should be on central bank independence, and taking actions that respect the line between fiscal and monetary policy, I'm sure, is something where the considerations have to be there everywhere. Okay, so as a more minor technical note, some of what we did in this structure was also to ensure that the balance sheet of all participants in the transactions, in fact, remained balanced. We had the banks where their deposits went up, but also their holdings of these special issue treasury bonds. And then we had the Federal Reserve that winds up with more reserves and more special issue bonds. Okay, and just a small technical matter is those zero coupon perpetuities also prevented the Fed's balance sheet from winding up with negative equity, which is something that would happen in other ways of executing the same policy. Okay, so maybe I should pause here and see if anyone wants to make any comment on anything that I've said up to this point, either the motivation or this particular program.
Debbie, there are some questions. May I read them out to you? Read them out?
Please.
The first one is, why is war spending different from pandemic spending? As your chart shows, during Second World War, the US accumulated a lot of debt, but paid it down later. Why should it be different this time? The second one is, how can we explain the relationship between monetization and central bank independence? Or is there a problem there? I guess the person
no, I'm sorry. I think did I unshare my screen? Are you okay still with this? So let me go to the first question first. So this question about debt was very high, and indeed we paid it down. So I just want to point out that debt topped 100% of GDP, and that was thought to be extraordinary. You know, now it's heading to 200%, and so I think, well, two things: the debt to GDP is much higher, and also there's a real concern that we don't have the fiscal discipline for whatever reason that we have had in the past. So earlier I alluded to the fact that I would have expected that after the Great Recession, rather than continuing to engage in deficit spending through what was really a pretty strong decade, we just kept on deficit spending. And, you know, we kept on cutting taxes. And so this idea that, in fact, countries that we used to think were disciplined enough so that the debt was in fact safe, well, maybe that assumption doesn't hold. So really the motivation for saying, I'm certainly not happy about proposing monetizing some of the debt. I would rather propose that we stopped cutting taxes and in fact started increasing taxes on those who are most able to pay them. But that suggestion is just not going anywhere. So the question is, do we let the debt continue to grow along the path like you see projected on this picture, or do you somehow try to slow down that debt growth? And it's because of the risks that, in fact, we won't pay it down and we will have a crisis because investors will stop buying the debt, interest rates will skyrocket, inflation will skyrocket. So this kind of monetize now in the face of the current crisis, in the face of the current lack of fiscal discipline, is definitely a second best kind of idea. And I'm so sorry, could you repeat the second question?
Of course, I may. It's about the relationship between monetization and central bank independence. I guess the implications for central bank independence going forward as a result of monetization.
Okay, so my sense of history is that the argument for central bank independence is that, in fact, governments will be very tempted, political entity, the political part of the government will be very tempted to want to spend a lot of money and not have to raise the taxes to pay for that spending. And one way to get around that budget constraint is, in fact, monetization. When the government can control the money supply, they can use inflation as a substitute for, or monetization, inflation as a substitute for collecting tax revenue. So the fundamental justification is that you put the central bank in the hands of technocrats and you give them a mission which includes price stability, so that they actually have some latitude to push back against the rest of government that might want to have a higher inflation rate than it otherwise would. Now, if the central bank becomes complicit in lacks fiscal discipline and starts monetizing the debt, there is the sense that there could be the question, well, first of all, a lot of people, at least in the United States, question the legitimacy of too much independence for a central bank because it's an unelected body in a democracy. If it isn't seen as behaving quite responsibly, then why should it have this extraordinary privilege of being independent? So that's why in terms of thinking about these proposals that try to be very careful about making sure that fiscal directives stay where in the US they belong, which is with Congress, and that monetary policy doesn't step over the dividing line between fiscal and monetary policy too much, is partly so that when things don't go well, the central bank doesn't get blamed for it. And I think there is a concern that the more central banks do, well, they might get credit if things go well, but if things don't go well, they might get the blame, they might become a scapegoat, and that could lead to a loss of their independence. Okay.
Can I just add one little twist to that? And that is your second bullet point. When the legislature requires the Fed to buy these bonds, isn't that direct interference with independence? They could just do that, continue to do that in general, They just decide, now we're going to issue some more of these bonds and require the Fed to buy them.
Well, if they didn't, okay, so what I'm trying to do is have, I really want the government to say we need to monetize some of our debt. I actually don't want the central bank to be making that decision. And so just like with the credit support programs right now in the US, I want the Fed to be the mechanism, and they're in fact the only available mechanism to monetize anything. But again, I don't want them to affirmatively be making the decision to monetize. So when generally when and this is going to come up later, and I'm just going to say generally when central banks buy debt, it's not monetization, and so that's actually where the distinction is. And well, we'll get to, let's see, how are we doing on? Oh, we're doing terribly on time. I don't
so
want to.
We should leave you alone.
What? Pardon?
We've got time. Don't worry.
Are you sure? Okay. Shut me up at any time. I could go on for a long time. Okay. So, I mean, there are a lot of things that central banks are allowed to do, and one of the things they have is discretion in how much, what to do in terms of open market operations, how much government debt to buy or sell at any point in order to fulfill their mandate, which in the US is price stability and maximum employment. But what I'm arguing is that in this case, this is very different because we're explicitly trying to spend a lot of money and not have the federal debt go up as a result of it. That is not to create an obligation that eventually has to be repaid. So, I mean, really, this is a fiscal policy. And I would say that any time that there's true debt monetization, it is a fiscal policy. It might be carried out by the monetary authorities, but it's fundamentally fiscal to monetize the debt because the government is basically getting goods and services or directing where money goes, and they're not paying for it. They're not paying for it with current tax revenue or with an obligation to pay back debt holders in the future. So I'm gonna, I don't know if that's satisfactory or not, but we can circle back to it when I talk about the distinction between, more about the distinction between monetization and normal monetary policy or quantitative easing.
Sorry, Debbie, if I can sort of, I'd like to add to this, and then I have a question of my own. But so I used to work at the Bank of England, and I quite like the way the Bank of England does it. I mean, again, it's a different structure, which, you know, doesn't travel, may not be able to travel to other countries. But the government has an overdraft account at the Bank of England, just like everyone else has an overdraft account. So, and that's being used to monetize some of the debt in the UK. And it's understood because it's an overdraft account, it's temporary. And so it can't be permanently funded. The other thing is that the central bank decides on how large the overdraft is going to be. So at least there is a token sort of disconnect between fiscal policy and the central bank buying this. I mean, you know, this is sort of nice.
No,
it
I'm
looks
very
nice
glad you brought it up. And I have that, I actually talk about this example.
Oh, sorry.
Later in the talk. So I'm going to argue that the BOV has not yet monetized that debt. Okay, so what I'm going to do is I'm going to run through a few things really without elaborating on them, and then get back into these issues of the difference between monetization and other monetary policy and what isn't, because I think that is what's most interesting about all of this. But
can I ask
go ahead.
Just a quick question, which is, so I have heard the argument that one silver lining of traditional monetization is that there'll be an increase in the supply of safe assets. So that would address sort of the global safe asset shortage. Why not have more treasuries? Because everyone wants to get their hands on treasuries.
Well, actually,
are you buying?
Monetization reduces the supply that's available to the public, right? So for however much debt the U.S. Treasury issues, when the Fed buys it, it leaves less in the hands of the public, and it's actually been suggested that that's the reason for some of the liquidity problems in the repo market this last spring.
But if your chart is correct and you go from 100% of GDP to 200%, I don't know whether.
Okay, thank you for that. So in the United States, and I think everywhere, debt held by the public is actually defined as the sum of what's on central bank balance sheets and what is literally held by the public. So that 200% includes what the Federal Reserve would buy.
Okay.
Okay, so I should have included, but anyway, there is some scarcity now, because I think almost all of the incremental debt that has been issued to fund pandemic spending was purchased by the Fed. So there hasn't been a lot of increase in the liquid amount of treasuries available for the safe asset issue.
And obviously, your proposal would not add to the stock of safe assets.
It would not. It would neither add nor subtract. I'm not a big fan of the safe asset argument, by the way. I mean,
okay, thanks.
But that would be a tangent that we could talk about on another day. You know, I think it's just crazy to say we have these exploding fiscal problems, and boy, wouldn't it be nice to have a few more safe assets? I mean, you can always carve a safe asset even out of a risky asset. It's how corporations create A-rated debt. You know, they have, if you take a large piece of collateral and you carve out a small piece of it, you have safe assets. So I don't really think the world is in as desperate need for more safe assets as they are in need of some fiscal discipline. But at the moment, more than fiscal discipline, we need to deal with the pandemic. And so at the moment, I'm talking about how do we deal with the need to spend money when we've already kind of backed ourselves into a corner of potentially unsustainable indebtedness.
Okay, great.
Okay. So very quickly, you can imagine doing something similar in the EU, and I'm not going to talk about it because I know I don't understand the rules and the complexity of the EU well enough to do a good job of that. Rafet might be able to do it, so you can have him come and talk about it. So the reason monetization has been avoided for a long time is because inflation has been very destructive and difficult to stop, hard to bring down inflation expectations once they start to become unanchored. And so certainly one can't take the risk that monetization will create inflation lightly. But I'd observe that today, almost all advanced economies are persistently missing their inflation targets from below. And in fact, central bankers would probably welcome at least a small amount of additional inflation. That was evident in the recent policy change by the Federal Reserve. So the other thing about the inflation risk is it's always a matter of balancing risk. And we would argue that dealing with inflation, although it's not pleasant, it's certainly something that central banks know how to do. So say that some debt is, for one thing, I'm not saying monetize all the debt, just a portion of it. You could start out slowly, see what was going on with inflation, be cautious. But in any case, if inflation did climb more than you anticipated, central bankers can let the next recession last a little bit longer. They can start to raise interest rates. They can actually trigger a recession in the extreme. So inflation is a known enemy. Then the other thing I just wanted to comment on before I get back into the kind of the basic monetary policy stuff is I've been talking about these large advanced economies, and I think a lot of the people who are listening to this talk have to be wondering, well, what about us? You know, why shouldn't we do the same kind of thing? So I couldn't stress more that this is meant to be a response to an extraordinary situation. And at the beginning of this talk, I tried to suggest that at least on paper, it appears that many countries, particularly in Asia and the Pacific, do still have some fiscal space and monetary policy space. And I think that it's more prudent to rely on those conventional policies when they're available. Certainly, I think there's some additional risks for smaller economies that the US and the EU are lucky to be more immune from. I think that the chance that international investors are spooked by anything that looks like it's kind of a loss of discipline and a move towards inflation, it could cause interest rates to rise quite a lot. It could cause rating agencies to downgrade the debt. So I somehow feel those risks are going to vary across countries, but they're going to be more significant in developing countries. And I think the reason those risks are larger is related to the issue of whether the institutions in those countries are strong enough to really push back against inflation should it take hold. Okay. Okay, so this is, you told me I could go over a little bit, please. Well, I'll go through this quickly and then we can turn it back into a discussion. Okay, so I think part of the reason what I've said so far might seem confusing is that a lot of people are thinking about, well, are countries already monetizing their debt? And what's the relationship exactly to quantitative easing and these large balance sheet expansions and yield curve targeting and monetization? When I read the popular business press, a lot of people seem to think that in fact, this massive growth of central bank balance sheets already amounts to monetization. But certainly when I talk to central bankers, they don't think that they're monetizing. So what I believe, and interested in your thoughts, is that in fact current policies are not yet monetization, but they could move in that direction. So let's try to go through that a little bit more carefully. So my definition of monetization is that it occurs when a government funds its expenditures by issuing intrinsically worthless claims that the public is compelled to accept, effectively printing money. Okay. So the reason the proposal that we put forward is in line with this definition of monetization is because a zero coupon perpetuity like paper money is worthless, but the government is using the face value of that perpetuity to spend on real things, to put money into people's bank accounts. Okay, so this is important. This is very different than traditional monetary policy when the government sells its securities, the Treasury sells securities into the open market, investors buy it. Those securities are an obligation to eventually repay the debt that's issued with interest, and that debt is really debt. It's not being monetized. You've gotten money in, but you've created an obligation to pay back equal value. So when things get tricky is when a government, when a central bank purchases its own government's debt. Okay. So I think it boils down to whether and by how much the central bank's purchases directly reduce the value of claims by the public on the government. So basically, how much of the debt are you effectively defaulting on? Okay. So let me go back to traditional open market operations, where a central bank is buying government securities on the open market. The fact is, those claims on the government, the need to raise future taxes eventually to pay back those obligations, is not canceled out by the central bank buying that debt. Why not? Well, the central bank could choose to sell that debt back to the public at any time. That would just be another open market operation. So in general, central banks buy and sell government securities, but there's not the expectation that they're going to buy those securities and never sell them back to the public. And so, as I alluded to before, in measures of debt held by the public, there isn't a distinction, at least in how it's recorded in the United States, between what's held on the Fed's balance sheet and what's literally held by public actors. Okay, and so that's standard monetary policy. Okay, so now let's talk for a second about quantitative easing that ballooned following the financial crisis. And if you think about quantitative easing, they're very much like open market operations in the sense that those purchases of longer-term government bonds don't extinguish the government's liabilities. And if you just think about the mechanics of those bond purchases, they actually didn't even, that now that interest is being paid on reserves, what's really happening is that central banks are buying government securities, essentially from banks, and they're paying with them for interest-bearing reserves. Banks are voluntarily now holding excess reserves as assets. So the net effect of QE on the balance sheet of the public is essentially an equal exchange of value. The banks have traded in their holdings of treasury securities for interest-bearing central bank reserves. Okay, so that's why some people have described this whole thing as that the quantitative easing has the nature of an asset swap of reserves for government debt. Okay. Okay, so the consolidated liabilities of the government, consolidating the central bank and the fiscal authority, are largely unchanged by quantitative easing, and there's no forgiveness of debt. And now if you think about the recent monetary policy actions by the Fed or by the ECB or the Bank of England, a lot of what they've been doing is also akin to quantitative easing. In the case of the Fed, the purchases have, certainly they've provided liquidity to the treasury market. They may have driven up treasury bond prices, but they haven't literally monetized the debt because they haven't canceled the obligation. And now to turn to the Bank of England example. So the Bank of England is allowing the treasury there to run an overdraft account, but very importantly, it hasn't forgiven the obligation to repay. Okay. So I'm just arguing that none of this, by definition, is monetization yet, but it could evolve in that direction. So in the case of the Bank of England example, it would become monetization if the Parliament were to pass a law that forgives the Treasury having to pay it back. And something else that could happen is, say we have a central bank with a very large balance sheet now of government debt, And if the government could selectively default on the debt that was sitting on its central bank's balance sheet, that would also be monetization, because it would essentially cancel out any obligation to ever repay that debt. But that would be an extraordinary event. In many places, it would probably be illegal, and central banks themselves would actually need to be forced to participate in that. And I use the word forced because they have a mandate to maintain price stability. And so that's why they need to maintain the ability to sell the debt back to the public, to increase interest rates, to slow down inflation. Okay. So essentially, there would need to be a legislative change to the charter of many central banks to even make that a possibility. Okay. So from all of this, we conclude that what governments are doing now and with quantitative easing is really not monetizing the debt, and hence this proposal that because the debt is getting out of control, because we need to spend the money, because we're spending the money more reluctantly because we're worried about the debt being out of control, that it does make sense to do this limited monetization. So I'm going to stop, and I'm happy to discuss questions for as long as people have the patience.
Well, thank you very much. That's a very thorough review of this issue of monetization, and I have not seen any additional questions on the chat box, at least if my chat box is the right one I'm looking at. But let me try one question, however, which is the following, and again, it may not be, I may not have fully understood, but suppose the central bank already has some government debt on its balance sheet, and then it gets this additional debt which it cannot sell off. Throughout this scheme, they have to hang on to it, but they can always then sell off some of the other debt. And doesn't that sort of undo the idea that this previous debt wasn't being monetized somehow?
Okay, so yeah, I know it's really very complex. I'm smiling not at your question, but because it's really very complicated to figure out. But I can just say that the reason they can't sell this new debt isn't because they're prohibited from selling it, it's because it's worthless. It's intrinsically worthless because we designed it to be worthless. It's worthless because it promises to pay no one anything ever in the future.
Right.
So it's really not debt at all. It's an accounting device to allow them to monetize some of their fiscal spending.
Right.
And that's the whole point. It's not adding to the debt. And to me, adding to the debt means adding to the present value of future tax liabilities that you need to honor your obligations.
Okay, yeah, got it. Ozer, you had additional questions.
I have a few questions from the audience. We've got some time, I believe. One of them is, Debbie, you might like to take note, a few of them. What would you suggest to countries that are still experiencing high inflation rates? It's one question. The second, rather than this permanent monetization of pandemic-related paychecks to people, if these zero-coupon bonds are to be paid back by the government to central bank in staggered manner over the next 10, 15, 20 years, would this be less inflationary in terms of triggering inflation expectations? One other question is, would your suggestion affect the dealings with international agencies like the IMF, as IMF has mandated for countries not to borrow from central banks? These are the questions, Debbie.
Okay, good. No, I'm thinking about it. So as far as countries that still have high inflation, I certainly wouldn't, we tied this explicitly to pandemic relief for developed countries because they're currently in a situation with inflation which is lower than they want it to be, and without already having to worry that inflation expectations are hard to control. In fact, they're having trouble, or say they're having trouble getting inflation to where they want it to be. The situation for a country which is already experiencing inflation would only be worsened, I think, by kind of publicly saying, oh yes, we're going to monetize some of our debt. I mean, that's already a risk, and all the things I said about international capital markets losing faith and not investing in all would certainly apply. So I certainly am not suggesting that, and countries that have a higher inflation rate have higher interest rates, and with higher interest rates, traditional monetary policy is still more powerful. You're not struggling with the kind of the zero lower bound kind of issues. So I'll leave it at that. Now, the question of whether what we're proposing would raise eyebrows at the IMF is a really good question, and I haven't asked anyone at the IMF, but I have been talking to people at the IMF, so I will ask them, but I don't know the answer to that. I feel like, again, for the countries, well, for the regions where I think this is most relevant, which is the US, the EU, and England, I don't think the IMF intervenes too much, so I would suspect that they could get away with it, but it's just a guess. And then there was the middle question was more complicated, but I think it had to do with is there somehow a in-between place where you sort of pay it back, and so since it's sort of really like debt, inflation expectations stay more moderate, so somehow you can have it both ways. I just don't think that's possible. I mean, either what I tried to make clear is that either debt is monetized or it isn't. Certainly you can monetize a fraction of the debt, and that's effectively what this is doing. So I'm not saying countries should monetize their entire existing stock of debt. I don't even want them to monetize all of this year's deficit. I want very limited monetization to deal with a very urgent emergency in a very finite way, so that things don't get, and that's what I want to control expectations with. I don't want to control it with a half measure. I actually don't think a half measure kind of works, but it would be too to try to explain why.
That's all the questions I have.
Let me add perhaps one comment in relation to something I've heard about Malaysia and various other economies where there's a large informal sector, and where the informal sector has been quite severely hurt because it's in service-like activities and so on. And then the question how you actually distribute the money to those individuals comes up, and that is of course that's probably different, certainly different than in advanced economies where everybody has a banking account, where you have reasonable statistics on unemployment and so on. Just an additional complication for in some jurisdictions where financial inclusion isn't very deep, and where lots of people don't pay taxes, so you don't know their income, etc., etc. It's just a comment. It's not really a question, but it's another reason why it might be complicated.
Yeah, I think it's complicated, but in a way it might be simpler. And I don't know what's happening in Malaysia. I think of places like China where you have everyone using mobile payment systems, where you could, you know, to the extent that you have any kind of digital payment, you can actually skip all the complexity that has made this conversation so complicated and essentially just hand people money. I mean, in fact, in Malaysia, even if you don't have money on your cell phone, if there was some way of reliably just carrying a bag of cash to a village, and then it would be literally a helicopter drop. I mean, all of this is meant to be like a helicopter drop, and I guess there would be the corruption issue in any country, which would make a helicopter drop difficult. But if you could somehow just give cash to local officials, it would make all of this much more straightforward.
Right, true. Okay, I think we have taxed you enough, so to speak, and I would like to end this seminar by thanking you very much, Debbie, for I thought it was a fascinating talk on an important issue that's being debated, I think, in a number of countries. Certainly here in Malaysia, recently, one of the ministers suggested exactly that the government should monetize that is to some form of a helicopter drop, and which raised lots of questions in the press and so on. So it's an important issue, and you've clarified what the real issues are behind that, the differences between monetary and fiscal policy, and that it's really very much a fiscal issue. So thank you. I'd also like to thank the SEACEN Center for collaborating with ASB on this event, and also, of course, thank all our listeners for their inputs and for staying on in our joint seminar. So again, Deborah, thanks a lot.
Thank you very much. I look forward to seeing you live in not too long.
Likewise, likewise. Welcome to Kuala Lumpur when COVID permits.
Thank you. Thank you. Goodbye.
Bye.
Bye, David. Thank you very much.